ServiceNow just posted $3.98 billion in quarterly revenue, yet their operating margin is quietly collapsing. But is the business actually capturing the artificial intelligence supercycle, or are they deliberately masking a severe fundamental decay right underneath the hood? Wall Street is captivated by the headline beat, but does this mean the market is entirely wrong, or is there a hidden fundamental value investors are ignoring? When you analyze the top line, second quarter total revenue hit $3.98 billion, representing a massive 24% year-over-year revenue growth. How exactly does an enterprise software provider sustain that kind of velocity when corporate IT budgets are tightening? Most analysts are purely focused on this $3.98 billion revenue acceleration, praising management. But when you look closer, you realize a significant portion of this growth was artificially accelerated by a sudden surge in US federal demand. Government agencies pulled forward massive digital infrastructure upgrades from the third quarter directly into the second quarter, artificially driving that 24% growth. This means the 24% revenue growth isn't purely organic market capture. Instead, ServiceNow borrowed from its own future trajectory. Consequently, the firm faces a looming sequential demand vacuum as they try to hit their newly raised $15.78 billion full-year revenue guidance. The real question is whether the company can fill that impending gap with private sector enterprise deals, or if the back half will reveal a harsh deceleration. To fully grasp why this revenue pull forward matters, we need to look at something seemingly unrelated to sales. Notice how the GAAP operating margin collapsed to just 4.1%. How can a business scaling so rapidly experience such a severe profitability contraction? At first glance, headlines scream about an earnings beat, pointing to a non-GAAP net income per share of $0.90. However, the true GAAP diluted earnings per share was a mere $0.29. This massive gap exists because the firm relies on non-GAAP metrics to obscure the actual cost of running the operation. Specifically, management paid out $655 million in stock-based compensation during the quarter. That means 16.5% of total revenue is handed over as equity just to retain engineering talent, effectively diluting existing shareholders to preserve cash. When you subtract these equity payouts from the headline numbers, the core operational decay of ServiceNow becomes painfully obvious. The company is sacrificing its pristine profitability to fuel its rapid expansion into cloud workflow automation. This brings us to how the business is financing this massive growth. Think of it this way: total debt exploded to $7.52 billion, up dramatically from just $1.49 billion in total debt last year. Why would an asset-light software enterprise suddenly lever up its balance sheet so aggressively? The crowd assumes these bolt-on technologies will seamlessly integrate into the main platform. But the reality is that ServiceNow funded over $7.45 billion in second quarter business acquisitions almost entirely through borrowing. This sudden borrowing spree fundamentally alters the risk profile of the firm. The current ratio plummeted to 0.70, meaning liquid assets now barely cover immediate short-term obligations like upcoming payroll. To make matters tighter, the business suddenly took on $2.08 billion in short-term debt. This is where the real structural vulnerability lies. Management is racing against the clock, needing to generate massive operational cash flow simply to service this new commercial paper and avoid a painful refinancing cycle. Despite these mounting liabilities, there is one financial indicator keeping the bullish thesis alive. Annual contract value specifically tied to artificial intelligence just crossed the $1 billion threshold. How did they convince major corporations to actually pay for this new technology so quickly? Many observers assume every software provider easily monetizes the artificial intelligence supercycle. But the truth is, most vendors are struggling to turn experimental pilots into recurring subscription revenue. ServiceNow stands out because they secured 123 massive enterprise transactions over $1 million in annual contract value. This represents a 40% year-over-year jump in these elite contracts. They are embedding autonomous agents directly into heavy enterprise infrastructure, like automated IT service desks and global supply chain routers. This execution proves the firm possesses immense pricing power. For growth-focused investors, this aggressive market capture justifies the premium valuation. If the business achieves its target of having 30% of annual contract value driven by artificial intelligence by 2030, the near-term margin pain might actually be a brilliant strategic investment. To get there, management has to navigate a complex global environment. The current US dollar index is hovering around 101.10, maintaining a surprisingly strong position globally. Why does foreign exchange matter so much to a digital platform? Financial commentators often say software demand is borderless and immune to physical supply chain disruptions. But when you operate globally, the strength of the dollar acts as a silent tax on international growth. Management issued a clear warning, projecting a $35 million year-over-year headwind to third-quarter remaining performance obligations simply due to exchange rate volatility. Even if the company secures robust software contracts in Europe or Asia, the translated financial milestones reported to investors could easily miss expectations. With the federal funds rate sitting at 3.5 to 3.75%, this elevated yield environment continues propping up the dollar, suppressing international earnings. To offset this, the firm deployed $2.22 billion for share repurchases over the last 6 months to protect the stock price. The business is priced for absolute perfection, yet remains completely exposed to macroeconomic shifts outside its control. Let us return to the original question. Is ServiceNow truly capturing the enterprise artificial intelligence supercycle, or are they masking severe fundamental decay beneath the surface? The truth is that the business is doing both simultaneously to support its $3.98 billion revenue base. The company is executing a masterful land grab in next-generation enterprise technology, proving undeniable customer stickiness. Non-GAAP free cash flow generated $634 million this quarter, showcasing that the underlying operations still produce heavy liquidity. However, this top-line triumph comes at an enormous debt-fueled cost that has severely compressed GAAP profitability. Management has fundamentally altered the financial DNA of the firm, transitioning from a conservative software vendor into a highly leveraged acquisition machine. For the pragmatic investor, the current valuation does not offer a comfortable margin of safety. The stock is priced as if the upcoming demand vacuum, the $7.52 billion in total debt, and heavy equity dilution simply do not exist. Until stock-based compensation normalizes and the short-term commercial paper is cleared, this is a phenomenal company trading at a precarious premium. You must demand a wider discount before stepping into this high-stakes ecosystem today, but I want to hear your take. Does this aggressive debt accumulation make you nervous, or is it a necessary evil to win the artificial intelligence race? So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.